Also, one of the great advantages under the pension regulation is that you can take up to 25% tax-free, and that's an absolutely great sales point for this particular type of solution. So you get the tax relief on the way in, and you can take up to 25% of your pot up to certain limits tax-free as well. But the key aspect is that the pension, or a SIPP or a personal pension, is definitely thinking about the long-term retirement saving needs of an individual and what they want to achieve when they come into retirement.
This episode is sponsored by Saxo Markets. Hello and welcome to the Investing Insiders podcast, where we help you achieve financial well-being by making smarter money decisions. I'm Brianne, and in this episode, we're going to be looking at self-invested personal pensions, or SIPPs, which are designed to give you more control and flexibility about how you save for retirement. Today, we're joined by Warren Bright, Head of Intermediary and Private Client Services Distribution at Standard Life, to help us unpack what you need to know about SIPPs and whether they could be right for you. Warren, welcome to the show.
Lovely to be in. Thanks for having me.
Amazing. Well, it's a really interesting topic to dig into. I think we do get a lot of questions about how SIPPs work, what they're about, and the benefits that they could provide. So it'll be great to kind of get an overview of what SIPPs are and how they might differ from other types of pensions that people might have heard of.
Yeah, so a SIPP stands for self-invested personal pension. So what that essentially means is it's a type of personal pension, either account or policy or however it's described, which gives the saver essentially more control over where their money is invested. Most people will no doubt be familiar with workplace pensions and even the government and state pension that offers. But a SIPP sits in basically within the personal pension category. And the key aspect about a SIPP is that it offers a really wide variety of choice of investments, and it can go all the way through to more, it's called esoteric, so unusual solutions, things like commercial property, and if you do so have some gold bullion. They're really designed for those who are comfortable regularly reviewing their pension investments. Typically, they're sold through financial advisors, which means they are reviewed on an annual basis to make sure that it's suitable. And within Standard Life, we have our own SIPP, which is called the Active Money SIPP, and that offers in the region of about 2,000 mutual funds, and that offers a broad range of solutions.
That is a really good base point to start off from. You mentioned a little bit about the types of investments that you can pick out when it comes to opening a SIPP. Could you kind of give us a bit more about the different types that people could pick? And people might be familiar with some, so looking at things like funds, but is there anything else that you could put into a SIPP to, help grow your money for retirement?
Yeah, no, that's a good point. I mean, the optionality of a SIPP is quite extensive, I would say, but also I would be mindful on the fact that it's linked to the product provider. So some SIPP that's out in the marketplace could have a narrow investment range. Within Standard Life is actually quite broad, but typical SIPP investments can include funds, so things like mutual funds, insured funds, stocks and share, investment trust, something that's called ETFs, which is exchange traded funds. Government or corporate bonds can sit within that, so you can hold national savings solutions within that. You can hold cash. And as I said before, if you're a business owner, then actually you can include commercial property. So you can have that product can be made available to those business owners who can actually put their commercial property within that. So what this is really important for is that from a SIPP perspective, and this is key with regards to growing a well-rounded investment pot, is that it can be really diverse. So not relying on one particular fund, not relying on one particular company stock to give you that breadth of solutions that people can get.
It definitely offers a lot of choice. And when it comes to taking action and deciding what combination of assets might be good to use for retirement, what's the best way to get started with understanding how each of them works and whether or not they might be right for your pensions portfolio?
Yeah, I mean, what I would say is that it's really important that if you've got a workplace pension, that is probably the best place for you to start. So speak to your employer who can provide you with support on that area. Because the advantage of workplace pensions is the fact that not only do you contribute it, but your employer contributes it too as well. With regards to the SIPP or a personal pension, you can absolutely look to take those solutions out directly but obviously you must be conscious of the fact that you're making those decisions yourselves. So therefore, within Standard Life, we work very closely with financial advisors in the UK, which there are about 27,000 that are out there at the moment giving clients advice. And that's absolutely fundamental to make sure they're making the best recommendations for those clients, because ultimately it's a really important product. It's a really important nest egg that someone's putting money into to secure a retirement that meets their individual needs.
Definitely. And with a SIPP, what are some of the tax benefits that people might be able to take advantage of?
Yeah, no, there are a couple. I mean, because a SIPP is basically what's classed as a personal pension, contributions, and this is the same for any pension that exists in the market, including your own workplace scheme. They receive tax relief, and that's basically at your marginal rate. So in a really simple way to explain this, if you're a basic rate taxpayer, an £80 contribution that you make towards your SIPP or personal pension can become £100 in the pension once basic tax relief is added. Higher and additional rate taxpayers may be able to claim further relief, but that's very specific on their circumstances. In addition to that, investments made inside the pension can also grow free of UK capital gains tax and income tax, although tax may apply when the money is taken out. So if you're taking that money out for income perspective, that would again be taxed at your marginal rate. Also, one of the great advantages is the fact that under the pension regulation is that you can take up to 25% tax-free. And that's an absolutely great sales point for this particular type of solution. So you get the tax relief on the way in, and you can take up to 25% of your pot up to certain limits tax-free as well. But the key aspect is that the pension or a SIPP or a personal pension is definitely thinking about the long-term retirement saving needs of an individual and what they want to achieve when they come into retirement.
Absolutely. And I guess kind of looking at the lifespan of a SIPP, what's the earliest you can open one? And for somebody who's thinking, okay, I'm going to put my kind of pension strategy together, what age can they start to think about taking money out of it at the moment? Obviously, pension rules change quite frequently, but at the moment, what's the kind of age that people can start taking money out?
So, yeah, with regards to contributions towards the SIPP, you can do it right from outset. So there are junior SIPPs available within the marketplace. And a junior SIPP can be a really powerful solution because contributions have the opportunity to grow before the child reaches retirement age. But it should usually come after parents have considered their own financial resilience, things like pension savings, their own personal debt and emergency savings for if they're required. And it's also worth sort of weighting it against shorter term options such as junior ISAs because the money is locked away until pension age. And that's the really important point. The money that you put into your pension typically cannot be accessed prior to age 55. And the rules are being phased in at the moment so that eventually that 55 will be 57. So that's the earliest in which you can start to allowable take your benefits. There are certain scenarios where pensions can be taken earlier. So if you're in a certain profession, I'll use quite topical a footballer. There are certain government rules which allows those types of professions where your career is over a shorter period of time where you can access those. What typically happens is what we find is that people now are looking to start to access their pension maybe around 57 or maybe even 60 or more, but as part of a phased retirement. So reducing the hours that they're working and going into retirement on a part-time basis until they fully look to take the full benefits from their pension plan. And it's really important that any individual that is considering this is that they're looking at their total pension pot, the income that they're required and over what period of time that income is required, because they are essentially the key aspects along with the potential investment growth that can be achieved about determining when an individual can retire. And obviously that's very individual. Depending on what the individual wants to do, what their retirement ambitions are, it can be very tailored towards the specific needs of an individual client.
So I think what's really interesting about SIPPs is the fact that you do get so much flexibility and there's a lot more independence in terms of actively checking how the performance is going, making adjustments, and I guess aligning it with your overall strategy to build enough money for a comfortable retirement. So for anybody who's thinking about opening a SIPP or already has one, how often should they be checking the performance of their pension funds or pension investments?
Yeah, really good question. My answer to that would be that the contributions that you make in towards a pension pot, you're typically thinking of long-term benefits. So therefore, you're investing for the long term rather than an immediate return that's going to hit a certain threshold that you're looking to then access the money. So within the UK, typically financial advisors, when they've advised their clients to take out a SIPP, are looking to review probably annually. That's a slightly change. It may be, depending on the individual circumstances, it may be more than annually, or it may be less than annually as well. So you may be looking at a more regular basis. But essentially, you're investing money for the long term. So therefore, checking an investment performance on a daily basis, it wouldn't be something that I recommend, because typically you're investing in the overall markets, in particular markets around the globe. And volatility and fluctuations can happen, and that shouldn't drive your decisions because of some immediate change that you've noticed within your pension pot. That said, what I would be looking and recommending for people to do is that on their build up to retirement, so if they're maybe 5 to 10 years out, is absolutely checking their pension benefits overall. So you should be able to get through an annual statement each year, which tells you that your pension pot, and there should be some narrative within that statement about the likely ability to draw income from that and what that could mean with regards to an annual income, to make sure that your contributions that you've made means that you can, again, live a retirement that you really want to do. And that's really that's vital, because if you look at it and you realize actually there is a shortfall, that gives you the opportunity to increase contributions, obviously if it's affordable.
This episode of the Investing Insiders podcast is sponsored by Saxo Markets. Saxo provides access to a broad range of global assets through a sophisticated trading platform. You can trade US stocks from as little as $1 per trade and UK stocks from $3 per trade. Please remember that all investing involves risk. The value of your investments can go down as well as up, and you could get back less than you invest. Terms and conditions apply. Visit Saxo Markets to learn more. With pensions, sometimes what can happen is people can get a very fixed idea of, okay, I've got this pension and that is going to see me through, or I've got this pension and I don't really need anything else. Is a SIPP something that you get and you kind of focus all of your pension building efforts on that, or can it sit alongside other things, say a workplace pension or another type of personal pension?
Yeah, absolutely. It's a complementary product. Typically with a self-employed person, they won't have a workplace pension in place if they haven't been in an employed role previously. So they can use a SIPP in order to fund their retirement. What I would say, though, is that an individual, if they have a workplace pension scheme, they can look to increase to that scheme. However, a SIPP can absolutely complement the overall contributions going into the overall retirement pot that an individual could look to accumulate over their years of making contributions towards it. So it should be a consideration about what your income needs are, the ability and the speed require access to that money, and then also about the level of risk that you're going to take with regards to the investments that you're going to put into your overall pension pots.
Yeah, so I mean, that's quite a nice way of looking at it. So it's, part of a package of things that you could be doing to support your retirement efforts. We've picked up on a few of the benefits of SIPPs. So looking at things like the flexibility that you get, a bit more independence and control over the types of investments that sit in your account. Are there any drawbacks to be wary of when thinking about potentially opening one?
Yeah, there's a couple of things that people need to be conscious of, which is why at Standard Life we're an absolute advocate for financial advice. So we recommend that if an individual can afford to have financial advice, they should absolutely look to try and engage with a professional financial advisor who is an expert in this field. The key elements that an individual needs to consider is their ability to fund the pension itself and the level of contributions that they can make to it, alongside their other individual needs and their family's needs as well, and their other expenditure that is non-negotiable. They also need to consider, depending on the type of investment, as I said before, investments can go up and down. If we saw what happened over the period during COVID, the stock market took a big impact, but it bounced back very quickly. So the value of your plan can be, I would say, volatile over that period, depending on the type of investment that you make. And also, of course, what I said earlier is that typically moving forward, you'll be able to access your pension from ages 55 onwards. So you need to be absolutely key that the money that you're putting into a plan, you do not need access to those funds until you get to that age.
It's really getting quite clear on, the money that you can afford to keep going until you need to access it until that point, and exploring some of the other accounts that you did mention as well. So if you need funds sooner, looking at things like ISAs and other savings accounts, which could provide that liquidity and the ability to access the money when you need it. We kind of touched on this a little bit earlier in terms of SIPPs being a potential option if you're self-employed and you don't have a workplace pension. Are there any other types of workers who might also benefit from thinking about using a SIPP?
Yeah, I would say that, again, if you look at I think that's twofold. Self-employed individuals would look to take out a SIPP because they don't have that workplace scheme. And we would always recommend that for any individual that is employed is to really seriously make sure that you are considering the workplace pension of what your employer offers, because not only, as I said before, are you contributing to that, your employer is contributing to that as well, and also all the tax advantages of that. But if you are looking for diversification, if you're looking to grow your pension pot outside of that workplace pension, say, for example, it doesn't offer some of the investment solutions that you would like to initiate, then a SIPP is a really good place for you to take that out. And you can do that relatively straightforward online. There are a number of providers in the market, or again, as I said, you can speak to a financial advisor, which we would highly recommend to make sure that you're receiving the best advice for your individual circumstances.
And again, looking at the breadth of SIPPs as well, it was quite interesting that you can open one for children and get that retirement kind of ball rolling from quite an early age. So how important is it for parents to be considering things like a junior SIPP? Because obviously your child's not going to be able to access that until they're in their mid-50s. So does it make sense to kind of look at options like that?
Yeah, no, I think the key point regarding a junior SIPP is that they receive basic rate tax relief on pension contributions. So it is a really valuable benefit for paying that into the fund for your children. For non-earners, up to, you can pay $2,800 can be paid in each tax year, and that can be topped up again by the benefit of tax relief to $3,600 gross. So what that means is that growth, again, inside the pension is also tax efficient, although withdrawals in retirement may be taxable, as we discussed before. So if the parents have the accessibility and funds available to put that into a junior SIPP for their children, or even grandparents doing it for their grandchildren, what you're really doing there is building up a nest egg that the children will not be able to access until they reach retirement, and you're providing them at the best possible start. And this is what we always recommend, that you pay into your pension as much as you possibly can do, within obviously your own limitations, but as soon as you possibly can do. Because if you want to reach retirement, it's about building that pension pot. And the sooner that you do it, the better chance you have about achieving your retirement needs when you come into that period.
Absolutely. It does give you that solid foundation, and that money is in the process of potentially growing and helping you achieve those goals that you want in retirement as well. If we shoot forward a little bit, and if somebody is slightly later in their career and, they're looking at their retirement savings or whatever they've built up so far, and they're just a little bit concerned that it might not be enough, what are some of the things that they can consider to give them a bit of a boost and, try and align what they have built with the type of lifestyle that they want to have when they retire?
Yeah, no, it's a really good question. I think it's about understanding, there's a couple of elements there about what is your disposable income that enables you to pay money into a pension, which then receives all of the tax benefits that we've spoken about. But also, as I mentioned earlier, Brianne, it's key for an individual to understand that retirement doesn't need to come immediately. that's definitely changed culturally within the UK more recently. So it's about thinking about how many years do you think that you can effectively work for to draw that income to pay into a pension, and the options that you have available as well. So thinking about other considerations about not only the pension pots that you've accumulated, your contributions or NI contributions rather, and the level of state pension you're going to receive in later years, and your ability to phase your retirement. So moving from, for argument's sake, from 5 days to 3 days a week, but accessing part of your pension product to draw in an income that means that overall you're still basically on the same level of income as you were if you were fully employed as well. So there are a number of options available for individuals, but the key aspect is for an individual to understand that what is their level of disposable income and what is the level of retirement needs they're going to have when they look to fully retire.
And it's, so important to kind of think of it that way. I really like the parts that you were emphasizing about not necessarily seeing a pension as a full stop. It's more of a comma and what comes after. So what would your life look like? Is it more just phasing out working rather than stopping working altogether? There are lots of different things that you can consider. It's not necessarily just a period of time where everything changes. It might just be adjusted for a period.
Exactly that. And there are products within the marketplace that you can access, such as fixed term annuities, which Standard Life offers along with our SIPP as well, where somebody can take a fixed term annuity rather, put a lump sum into that, and that can pay a level of income over a set period of time. I think the scenario of where people hit, for example, 65 and then stop working altogether. So on the Friday they were working, on the Monday they stop, is certainly something that is now seen less and less. So people do have optionality. Also, post-COVID, you saw a number of people that were previously retired go back into work, and that doesn't stop you to do that. And even if you do go back into work, you are still able to pay into a pension plan. You can't pay in as much, so there are definitely limitations around what you can pay in. So there are different levels that the government allow you to do, but you still can build up a pension pot even if you have started to access that.
Yeah, that's it kind of gives it a bit more life, really. Like it's another stage where, similarly to if you were to diversify your career options in your core working life, during your retirement years or pension years, it's really just about finding that balance that works for you and helps you live the lifestyle that you want to lead and afford things going forwards. It was really interesting, your point about leaving money invested if you're thinking about things like phased retirement. So at least at that point, your money's still benefiting from some level of growth as you are in that phase of life.
Yeah, absolutely. And then that's something that you can definitely look at about your level of risk and the investments that you've got within your pension plan to understand how that pension pot could grow. Because just because you're starting to access it, it doesn't mean that the pot that you've got remaining still that's sat within the pension won't be being very active and looking to grow again, depending on the underlying investments that you've invested in.
Yes, for sure. And for people kind of still in the early stages of their careers, something that tends to come up sometimes is the idea of, is there any point in me starting now? Retirement age is so far off. Would it be better for me to, either opt out of my personal pension or wait to get started with a personal pension or a self-invested personal pension? What are some of the things that can help motivate that way of thinking into making sure that you just get started with, wherever you are in your career?
No, correct. I mean, what I would be saying to those individuals is, I think it brings me back to the conversation, especially if you're employed and you have a workplace pension, is that not that you're getting free money, but your employer is going to be paying into that as long as you do. So again, you've got a huge amount of tax benefits, as we spoke about before, with the tax relief that you're receiving on the way in, and then also the tax-free cash that you can have on the way out. And if you're able to pay into it and your employer is paying into it, then essentially you're giving yourself the best possible opportunity to achieve the retirement needs that you will have in later life. And I think one of those aspects as well is that time moves fast very quickly. And if you're looking to understand, especially in a world where inflation has been particularly high, the level of or the value of a pension plan that you need in order to fulfill your retirement ambitions has increased. And therefore, as soon as you pay in, the better possible opportunity you have is in order to fulfill those retirement needs. And of course, if you're 18 and you don't think you can get the benefits until you're maybe 57 or could be 60 or even later, then it seems a long time away. But little and often can have a huge impact, and especially with the growth that you can accumulate again from the investments that you've got within the SIPP itself, can give you again a huge amount of growth, and that enables you again to fulfill your retirement needs.
Absolutely. And what are some of the key pension tips that you kind of hope listeners take away?
I would urge all of your listeners to make sure that they are very clear and understanding about a workplace pension and the value that provides to you, and also consider a pension plan not only on the amount that you put in, but also all the tax benefits that you get as well. And that retirement is very, very different now compared to where it was 40 or 50 years ago. You do have optionality. You do have the ability to phase your retirement, and there are a number of different solutions out in the marketplace. I would also urge your listeners, where possible, if you can afford it, please do speak to a financial advisor. They are the experts in this field, and they can work alongside you to help you understand your level of income needs that you think you're going to want to achieve in retirement, and can build a really professional, well-structured plan to enable you to achieve that. So that would be my key headlines.
Fantastic. Well, Warren, thank you so much for joining this episode. I think it's been really great to dig into exactly how SIPPs work and the benefits that they offer, and also exploring all of the pension options available. So looking at things like workplace pensions and finding that balance. So thank you so much.
Thank you.
Thank you so much for joining our Investing Insiders podcast. If you like the episode, please subscribe and leave us a 5-star review on your platform of choice. For the latest money news and deals, you can sign up to our weekly newsletter at investinginsiders.co.uk/newsletter-page. We've also got a suite of guides, tools, and calculators on our website at investinginsiders.co.uk. You can also keep up to date with us on TikTok, Instagram, and YouTube. Thanks for joining us, and we'll catch you in the next episode.